Prosperity is more than a number. It's the power to shape what's possible for you, your family, and your heirs. Here you'll find ideas for building wealth, safeguarding it, and translating it into true prosperity, with insights from actual business owners and financial professionals. Welcome to the FDP Prosperity Podcast, hosted by your Chief Prosperity Officer, Mark Chandik.
Hi, I'm Mark Chandik. Welcome to the first ever Prosperity Podcast. Today I'm excited to introduce our very first guest, Matt Coats, President of Coats Surety Services in Laguna Hills, California. Let me tell you a little bit about Matt. Despite his appearance, he has 30 years experience working in the surety world with large and small contractors alike. So he's seen it all. He also has the distinction of one of the only mother-son surety companies in the United States. So that makes him unique for sure. So welcome, Matt.
Thank you.
And I thought we'd just dive right in and tell us a little bit about Surety 101.
Sure. Well, surety is it's definitely an insurance product, but it acts more like a financial product. I like to call it kind of a potential loan. Is a three-party agreement that guarantees that a certain contract or a project will be completed on time and on budget, and that surety bond guarantees financially that will happen. The three parties that are part of a surety bond agreement are a principal, an obligee, and a contractor, or the surety company. So the obligee is typically the owner, the one that is funding or paying for the project to be complete. The surety bond or the surety company is the one that guarantees that work will be done, and obviously the principal in this case would be the contractor to get that work done. So one of the ways I'd like to look at a surety, or try to explain to somebody what it is what it is not. So a surety bond is not an insurance policy. So an insurance policy will guarantee loss of some sort of peril that has taken place, a fire or an accident. In the case of a surety bond, it actually protects the owner from any kind of loss that might have happened on a contract. So a contractor will necessarily have to get that bond and pay for that bond, but that bond will actually guarantee and protect the owner. And that's really the difference between insurance and what a surety bond is.
I'm clearer on that now. What is a general indemnity agreement? You hear that all the time in your world. Can you tell us a little bit about indemnity?
Absolutely. So that's another way that's a little bit different than insurance. So if there is a loss on a surety bond, there is an indemnity clause that a contractor has to sign, as well as their spouse, any trusts, or other related entities, that promises to pay back that surety for that loss. And that indemnity agreement guarantees that.
I see. Let's switch gears now. And how does someone qualify for surety credit? What do you look at?
Well, as a surety underwriter, they look at what they call the 3 C's of surety. That is character, capacity, and capital. The first C being character. That's the most important one. That demonstrates a contractor's integrity and commitment to get a job done. So one of the things they do is they'll look at a personal credit report. They'll look at that credit score, make sure that they're making all their payments on time. Look for any bankruptcies to see what kind of character they have as far as taking care of their commitments. The next C is capacity, which is the contractor's ability to manage a job. Do they have the labor? Do they have the equipment? What is their capacity to get that amount of work done? And lastly is capital. Do they have the financial wherewithal to cash flow a job and to weather any problems that might occur?
I see. What I'm intrigued about is the whole concept of character, because it is unique. What you're saying is that you really know your customer. Do you go to bat for them with the surety company? Does your word mean a lot to the surety company when it comes down to saying yes or no, we're going to go ahead and bond a particular job or a contractor?
Absolutely. As a surety bond agent, I'm the eyes and ears of that underwriter or the surety company out in the field. So if I'm going to bring a piece of business or a new contractor to a surety company, I'm going to have to first vet that client, whether I'm going to ask about them in the market in general, what kind of reputation they might have. And my value that I bring is that my trustworthiness that the underwriter has with me comes to bear because I can vouch for that client when I bring them to them.
And you have to have, my assumption is you have to have a pretty good accounting background because you're looking at their balance sheet, their P&L, to make sure that they have the capacity and the wherewithal before you submit them to a surety company? So you spend a lot of time looking at their financials and giving them advice, frankly, on how to potentially put them in best order.
Yeah, I would say one of the best parts about my job is all the hats that I get to wear. And not only do we look at the balance sheet and do financial analysis and then have a good understanding of the financing involved, but also the contracts. We review a lot of contracts and obviously the bond forms, and we look for onerous clauses and try to provide, that extra service to the client to let them know to look out for certain pitfalls and things to be aware of.
Now, I've also understood from clients that their current assets need to be very, very healthy. A thing called current assets on their balance sheet. Could you talk a little bit about what current assets are and why they might be important?
Sure. Specifically, we look at working capital, which is the current assets minus the current liabilities. And from an underwriting perspective, we really look at cash, receivables, and on a contractor's balance sheet, the underbillings. Those are the primary assets that we look at when looking at working capital.
I see.
And in general, we're trying to find if a contractor has a certain backlog, we want to make sure that working capital is at least 10%, we call it the 10% case, of that backlog.
I see, okay. So once you have a contractor and they look like they qualify for a bond, the next subject, of course, is what does it cost? What is the rate that they will be charged? How is that determined?
The rate's determined on a number of factors, but primarily is that financial strength. We want to make sure that just like when you apply for a home loan, the more assets you bring to bear, the better the rate is going to be. One of the other things that's important for a contractor to understand is that the quality of the financial statements that they provide to the underwriter is also a key determining factor. There are three different kinds of CPA prepared statements that you can get: a compilation, a review, and an audit. And anything, when you're looking at bonds over $1 million, most surety companies will require at least a review at a minimum.
I see. One of my future guests is going to be a CPA who works in your world, in the contractor world, so I'm sure he'll be talking about that sort of thing. Another subject close to rates, because I think it probably has a bearing on the rate, is claims history. What do you look at when you look at claims?
When we look at claims, we look at the type of claim that it is, because many claims happen day to day with any given contractor. But what we really want to be concerned with is loss. If a contractor experiences a claim, that happens every day. But a loss is something very much different and will actually be very detrimental to a contractor's ability to obtain bonding.
I see. And do you get involved in the claims process? I mean, are you one of the first phone calls that is made from a contractor that's panicking that something bad is happening?
I'll say with the good ones. With the good ones, I'm the first call that a contractor makes. Oftentimes I'll get a call from a claims person or the underwriter that they received a claim because a contractor hasn't let us know that there's a problem. They've been trying to fix the problem on their own.
I see.
My recommendation to any contractor that has a potential problem out there is to get ahead of it, be upfront and honest with the surety. Let them know that there's a potential problem and what your possible solutions are to resolve it.
So the earlier the better, so that a little problem doesn't necessarily become a really big problem.
That's correct. One of the main reasons there is we have a lot of experience with these sorts of things and might have some insight that the contractor may not have and can provide possible solutions before it gets too far down the road.
That's great to know. Can you tell me a little bit about why those bonds are needed and a little bit about when private versus public, for example, and one might be needed and under what scenario?
Absolutely. Most public works projects are required to be bonded because of something called the Miller Act. The minimum amount of what a project might be required to be bonded may differ by owner, but in general, it's about $100,000 to $250,000, again, depending on the owner and the situation. As far as private works, that is generally going to be dictated by either the owner or the lender. If a lender is financing a project, they're going to require that job be bonded so that their investment is secured.
Okay. And general contractors hire subcontractors. So tell us a little bit about bonding requirements for subcontractors.
We work with several general contractors, and there are actually many general contractors out there that require that any subcontractor at a certain value be bonded. So that subcontractor will then provide a bond to the general contractor, which provides a little bit of protection for the GC. We recommend that because, as I say to many of my clients over and over again, it doesn't have to be your fault to be your problem. And if you've got your subcontractor that's bonded, may have a dispute with a supplier or a third-tier subcontractor, that provides just a little bit of extra cushion and a lever to help you resolve a problem and keep the project moving.
Do the general contractor and all their subcontractors have to use the same surety company, or do they each have their own choice?
They each have their own choice. In fact, my recommendation is that once you have a surety company, you keep it for as long as you can. You want to establish that relationship with your surety company so that if you do have a stretch or you do have a problem, you have that relationship to fall back on and that experience with that surety company to help you get through those issues.
Back to your idea of character.
That's correct.
Okay. Working with a surety bond agent, I think you've already described some potential value or great value that comes from working with someone like yourself. Are there some other reasons to work with a surety bond agent?
Absolutely. A surety bond agent has a large stable of professionals in our network. We work with CPAs, we work with attorneys and bankers, as well as other contractors and different surety companies that have a lot of insight into the construction world. So not only do I bring my experience to bear, but I bring the experience of everybody I work with and all the stories that they tell and the best practices that they might bestow that I can share with our clients.
Mm-hmm. Now, are there some instances working with clients that you might like to share today that are big success stories or horror stories, something that should be avoided that come to mind?
Unfortunately, there are many nightmare scenarios. There's several success stories, but I guess one that I could tell is when a general contractor started working out of his geographic comfort zone and started working in a new area and got involved with an owner that he was unfamiliar with on a project that was a little bit larger than he was also used to doing, and went sideways real fast. And because he didn't know the owner, didn't know the area, the owner began to withhold all of his cash on the job, told him to stop, and that impacted all the other work that he had going on that was, better work for him. So one job, again, going back to my point, doesn't have to be your fault to be your problem. Because of the one job, all these other jobs went south, and the contractor unfortunately ended up going out of business.
Oh, that is a horror story. Something just came to mind. A lot of Southern California contractors are doing business out of California. They're doing business in Arizona, Nevada, and other jurisdictions. How easy is it to get bonding out of California working with, let's say, a California surety bond expert like yourself?
Well, we have contractors that work throughout the United States, including Hawaii, and it's not a problem necessarily to get bonds in other states. My only suggestion would be to contractors that are looking to get into a new market is to sort of dip your toe into it first. Go small, build up a presence, get to know the marketplace, and grow from there.
Mm-hmm. In your experience watching companies, big and small, for many, many decades, there are certain commonalities I'm sure that you see on those that are successful and those that are not. Maybe you could share a couple of the traits that you see in contractors that are successful in having a very long-term positive track record.
I would say, and I'll have to be a little honest here, the contractors I find that are most successful have very good relationships with their bankers, their attorneys, and their surety companies. And they rely on their experience and their partnerships to not only learn best practices, but also to have that help to resolve issues. But the contractors that also keep money in the company and have that financial wherewithal to weather storms are the ones that I find to be the most successful.
So they don't spend more than they make, they have liquidity, and that helps when things go south. It helps them weather the storm.
Correct.
Is there anything else you'd like to add, Matt? Kind of a wrap up here, or any other thoughts that you'd like to share with us on the subject of surety bonds?
I would just recommend to contractors to really look in, especially if they're new to bonding, to go through the process as kind of a stress test for your company. Because not only are you providing, a certain strength to yourself, but you're also getting that insight from the underwriter and the surety bond agent to help make your company a stronger one. And you're learning those best practices on how you can be more successful.
That's great. Well, thank you, Matt, for being my very first guest on Prosperity Podcast. And I'm looking forward to being with my next guest, and I hope you tune in. Thank you.